So we are going to talk today about how to analyze the information on the chart setup that I went through in the previous video. And we talked about having different time frames here and the different studies. So let's just get started. All right, so the main frame here is set up with 1,000 ticks, and I just happen to have 2 days worth of information here. 1 day isn't quite enough. 2 or 3 days is just about right. And the 1,000 ticks simply means that each of the candles, and zoom in a little bit here, okay, that each of the candles that forms is made up of 1,000 ticks. And I'm still not absolutely certain what this means, but it has to do with the amount of trades that are made in that. So I would say maybe 1,000 trades is kind of the way I think of it. And so when a candle moves very quickly, that means, especially on this chart, that there are a lot of people buying or selling in that range. So that's different from the time frame where each candle is simply formed within a certain period of time. And so that's why you can see like totally different movements. Let's compare, go back out again. Let's compare like what we see over here, this candle right here. So you can click on it and you can see, okay, that was at 8:30. So where was 8:30 back here? It's way back here. So all of this happened since then. The 8:30 candle was right here. So you can see it looks totally different in formation from this one. So what this tells us is that this dropped down very quickly, and then it took its time recovering. So you can see that there's a little bit more information there, versus over here, you don't really know how quickly it dropped and how quickly it recovered. That could have happened in just a split second. And you really don't know, if it trickled down and then zipped back up, or the other way around. So by looking at the 1,000 tick chart, you can really see a lot more information. So your candles are really important, and the way they get formed, which is hard to see on the still shots that I take, but let's just watch it for a minute. So you can kind of see it in real time here. Okay, so what I'm seeing here is that we're losing a little bit of momentum as we came to the top, and it slows down. You can kind of see it just kind of sat there for a little while. All right, now I'm going to go ahead and put my cursor over here so you can kind of see where it is. Now, if it gets above this point, it's probably going to shoot up a little bit quicker. Otherwise, it might drop down. So it's like it reaches this ceiling, and then it has to think about it a little bit to whether it's going to break through or not. And if it does seem to break through, like it just did there, then it might get excited and go up a little bit faster, just like that. So there we go. So then it kind of hesitates there, and that's when you see these candles, these dojis or red candles appear. A doji is simply like a little T. It's white. It has these hesitations every once in a while too, where it reaches a certain point, whether it be a ceiling or a floor from something that it has formed previously, and it has to think about, okay, what are we going to do in this situation? And is it going to go above it, or is it going to just have that as a new resistance level, a changing level, I should say. And so all right, right here, we can see it slowed down, and then it started to form a green candle and then another bigger red candle. And you can see that this green candle is actually below the previous 2 candles. The wick actually developed below them, and that's huge. That's actually huge, because then when the next candle developed, you can see that it was, it's going to drop. So depending on the trend and how strong the trend is, and right now the trend is pretty much flat, and so the likelihood of it dropping is pretty good. It's probably going to get down to this point right here. But it kind of scares itself too. If it drops too fast, it'll have a recovery point like this. You can see the recovery of these candles here, and now we've kind of formed a doji, and it's slowing down. It's thinking about it, and I mean, there's always a chance it could go either way. But it's not always 50-50. You can usually tell if it's going to be like a 70-30 or 80-20, and when it gets into that range, you really want to be able to make a trade because you're more certain of which way it's going to go. So candle formation, the speed at which the candles are forming, and see, there we go. I'm going to drop. I bet you it's going to drop down to at least this, maybe this, and possibly even down to that point right there. All right. So we'll see as I talk here what happens. Okay. So the other things that I'm looking at, candle formation is the first thing, but we're also looking at the studies that I have here, and we talked a little bit. Let's talk about the SMAs first. Because the SMAs are let's see, it's something moving average. I don't even remember what it stands for. Simple moving average. So it just calculates, depending on what amount of candles you tell it to look at, it calculates an average of where those candles have been. And as you can well imagine, on each time frame, it's going to be a little bit different because there's a different amount of candles in that period of time on that chart. Like for instance, on the 15-minute chart, we have two moving averages. This one here is 50 candles that it averages on, and then this one is 180 candles that it averages. It tallies its point on, and so the blue one is going to move a lot slower, and then the yellow one will react faster to each of them. And depending on what you see and which one is higher than the other and which one is crossing over, like here's a crossing point, here's a crossing point. And also if you see like the longer time frame, let's go down here to the longer time frames that I have, it will tell you a great deal of information. So like for instance, this blue line is pretty steady. It's pretty steady going straight up, and there's hardly any deviation there. This is our 4-hour chart. So each of these candles takes 4 hours to form. That's huge. And so it really slows down the process of what we're looking at. The yellow SMA here, the 50 SMA is just starting to tip down. So we can see over the last, and each of these spikes is 1 day. So we can look here for the last week, 1, 2, 3, 4, 5, and we're on Friday today. So the last week is starting to tip over and lose momentum. Now, when those candles actually, or not candles, when those SMAs actually get close together, that's when things start to happen. The candles want to meet, they tend to interact with those SMAs. Like right here, I would predict that this candle is going to want to go up. The price action is going to want to go up to meet that SMA, which in turn is going to, as the averages go along in the next day or two, it's going to drop to meet that. And so at this point right here, it'll probably meet, like maybe Monday, Tuesday, it's probably going to meet that 50 SMA. And so at that point, we would have to recalibrate our thinking and see kind of what levels it's met and what it's going to do next. And also, if I point out to you, the other thing that we're looking at here is you can kind of see, and I wish I could zoom in a little bit so you could see this better. But you can see that there's like a floor right here. It's formed a support right through here, and that point is like midway between the price action and that SMA. So that right there would be a pretty good indicator of where I think it's probably going to go. Is 52, 45, 80, somewhere's about in there, or 52, 50, something like that. Because remember the candles are going to go up and the SMA is coming down. So if it reached that point, I would say it's probably going to hesitate, go flat for a while, and then it's either going to drop or go up at that point, depending on what we see next. But up until that point, I would say it's a pretty certain thing that's going to go up. So if that makes sense, we kind of look at the averages there. And like right here, we're almost to an SMA, so that's going to act as a ceiling. And on the chart here, if you bring your cursor over here and touch it, you can see it highlight right there. See that yellow bubble? It says the level that the end of that SMA is at right now. So when it reaches 52.29.34, 52, we can go over here and look. That's way up here. 52.29.34. So it's in quarters. So right here, when it reaches that point, it will most likely bounce down just a little bit because that is going to act as a ceiling. If it doesn't act as a ceiling and it blows through that shows a huge amount of bullish sentiment, and it will more than likely continue up at that point. But we want to expect that it would probably hesitate at that point. Things like that. All right. So let's go talk about the indicators now that we have down here. And there's two of them that I like to use. There's the MACD, which we'll start with, and it's the, oh golly, I said it in the other video. I never can remember what it stands for. The something average convergence divergence. And what we've got here, we've got two lines that are kind of like our SMAs up here, except they move a little bit faster, as you can see. They're kind of going all over the place. So the distance between the lines is formed down here on this purple average line, and the distance is the length of this little, we're going to call it a candle for lack of a better word, and so and it's just kind of straightened out into this line. And so when it crosses over, at this point right here, that's called a golden cross because you're gaining momentum. And at that point, you can see it turn from a red candle into a green candle. So we can see that we've crossed this point and we are gaining momentum. And as we gain momentum, the distance between these two lines increases until we get to this point right here, which actually is sooner than it actually starts to turn. So you see what I'm saying here? The longest green candle right here is not actually at the peak where the MACD is. So when you start to see dark green candles form and we're losing momentum, you've got a couple ticks maybe, if at most, before it really starts to turn and drop. And if you're looking down here, that's fine, but also look up here and okay, so right here we have the longest green candle, and you can see that is at the peak up there. Can you see that? It's at this peak right here. And then the next green candle, we have a red candle up there. And then at the next candle, the second dark green candle, that's when we reach the peak of the MACD, and that's when we start to see, actually it was probably this one right here. That's when we start to see some drop in momentum. But by the time you get to this point, when you're scalping, it's almost too late to get in. So you need to anticipate that drop kind of before it happens. And the MACD is one of the most helpful tools in determining when that's going to be. Now, my favorite trick is to start to get in at that first dark green candle. And that would be like the first time it hesitates and drops down a little bit. It's a little bit premature. Once in a while, if it's moving really, really fast and you've got a really strong trend in one direction or the other, you might get by with it. But mostly you want to wait till you see like a couple of the dark green candles and get confirmation that it's turning over. But you don't want to wait too long either, because then you'll miss a lot of the price action and the movement. And since we're trading with such small little trades, you don't want to miss out on much. So anyway, that's the MACD, and you can see, okay, this is the cross the other way, and it is called a death cross. And then when it crosses over like that, then we start to see red candles. So that means it's dropping. And again, it works exactly the same way. You can see at this point, this is the lowest point up here, and the dark red candle forms right here, and we can see a great big green candle right here. And then it starts to go up. And since this is trending up right now, you're going to see a lot more movement, a lot more height, change, whatever, in the upward movements than you are in the downward movements. And this is why, let me just go over really quick, why it is that you want to trade. Let's see, how can I do this? Yeah, let me try it this way. This is why you want to always trade at the trend, because look at the difference between this point and that height right there, right? And this one to this one here, all right? So what I do in my trading is I will try to catch as much of that movement as possible. If you are trading the short term, look at how small. So the space between the top and the bottom of the peak, which, again, it's really hard to catch it right at the top or the bottom. It's almost impossible. So, it's going to be a portion of this line that I'm drawing here. You can see that the distance between if you tried to do that movement right there, it's only that movement, versus if you tried to do the movement up here, you've got a lot more height there to deal with. So the interesting thing is, if I took all of the long positions, if I got in here and rode it up as far as I could right here, so that's our first movement, and then we took the next, we waited for it to peak out and then drop and then show signs of it going up, and then we try to trade this movement right here. We stack that on top of there, or even overlap it a little bit, because you're never going to catch exactly the top and the bottom. And then you took this one here, squeeze it down, and stack that up. You would have the ability to make all of this in profit, versus this movement here and this movement here. So, and then like this movement here, we can do one more, which is hardly anything at all. But like from here to here. Okay. So I just think it's interesting, that right there, see the difference? It's almost half, and that's only like 3 trades. That's like 1 trade, 2 trades, 3 trades right there. And you can make that much in profit. That much price movement it's just way easier to make money off of, instead of trying to catch your downward movements. And it's just a lot riskier too, because you can see it just doesn't want to drop. So that's why you want to trade with the trend. It's just there's a lot more movement in the right direction, and it's easier to predict. It's easier to get in, to get out. And anyway, so all right, so look here. Let's try to see when this is a good time to get into a long, because the MACD is dropping and we're at a floor here, a support. So we want to wait to get into a position until we start seeing some movement upwards. See if we can determine when is a good time to do that. Okay, we see a dark red candle there, and it kind of turns into dark red and then goes away again. So it's a little bit tricky. All right, at this point, it's a little iffy, but I might get in. And I could get in like at this point right here. All right, there we go. And now we've got 2 dark red candles. And you can see I could have waited to get in because it's still hesitating to go up. All right, now at this point, you've already lost some of your gains. Like if I were trading 2 contracts, that would have been $100 right there that I would have missed out on. So I wanted to get in down here kind of before the movement started to really go up. Okay, I take it back. Now it's dropped back down and I could have gotten in again. All right, now we have an issue because now we've developed a little bit more of a drop. Haven't actually broken through that support yet. And if I had gotten in where my cursor is over here, I still wouldn't have made a profit, but I wouldn't have made a huge loss either. Okay, now I'm starting to get a little bit worried because it's kind of broken through that floor right there. So it's hesitating and going up. Like that. Okay, so now we've got another big green candle, and it's looking really good now. That's a really big green candle. Just waiting for it to go up. Okay, it just doesn't want to go up yet. But you can see on the MACD, the candles are getting shorter and shorter. They were anyway. Even so, though, they are, on average, getting smaller. So that's one thing that I'm looking at. But it is still dropping. So now at this point, I'm thinking, let's look at some other time frames and get a better picture of what's going on. And you can see, remember that ceiling that I said it would hit and probably drop down? Well, I kind of missed that when I was looking over here. I forgot to look over here, and sure enough, it did. It kind of acted as a ceiling. So if I had gotten into a position up here, I would have to then think, okay, how far down do I think it's going to go? And I would kind of follow an average line up this here. I could see it dropping down to this point right here. So 214. Do I want to hang on for that entire drop? And I think it'll recover, but do I want to wait through all of that loss, or do I want to go ahead and get out right here? Because I do think it's going to drop some more. And probably the wisest thing to do is to go ahead and get out and wait for the drop to finish, and then go ahead and get in again whenever it reaches the bottom. So that would be like 213, which is like right around this area right here. So it might even blow through this support right here. So those are all the different things that you need to think through while you're trading. And yeah, it's a lot of information to take in, and your brain can only handle so much before it starts to get fried. At least that's what I found. I don't think I could trade more than a couple hours. I wouldn't be able to think straight anymore. And I would be reacting and trading on emotion, which is a really dangerous thing to do. Okay, so let's talk about the RSI now. So the RSI is the relative strength indicator, and you can see that it stays within these two lines right here, the movement. Usually, if it goes above it, then that's what we called overbought. That means too many people have bought in, and the strength of the candles, the price point is it's not going to support itself. It most likely will drop. However, if it drops down, like over here, this is undersold. And you can see that happened after a great big movement like this, where it just like, it was yesterday, I think, it just lost a whole bunch of money in the market there. For whatever reason, you don't always know what makes it do what it's going to do. And sometimes you can tell if there's a piece of news or something like that comes out. But, like for this, I honestly do not know why it did that or why it even went up this morning. So, yeah, so you just want to, you want to be careful. And once it starts to move, it doesn't have to be a reason anymore. People start to panic and they see it dropping and they don't want to hang on. And so they get out. And they will sell very, very quickly, or they'll have computers that are set up to sell at certain points, and so your computer is actually selling, and then that can be a problem too sometimes. So that's why I like trading, because it's a real quick in and out, and when I'm away from the computer and I'm not looking at the screen, I don't really care what it's doing because I don't have anything invested in that. So I feel like that's why trading is a lot more um, safe and less risky than just buying and holding for a very long period of time. I know that just goes contrary to a lot of thinking that I hear out there, some mainline thinking, but that's kind of how I see it. So like I looked at that last night and I like, oh wow, I wonder why it did that, but that was it. I wasn't worried because I didn't have a position. So anyway, so you can see that it's very oversold. That means that it's in prime territory to be bought up again. And then when we start to trickle back up, you can see it, it didn't really go up in price, actually. It just pretty much went flat overnight. But the RSI was able to come back up to like the mid-range here. So when we started the day this morning, it was like, well, it's right where it should be. It's right in the middle. It's an average. It's neither high nor low. So, the RSI actually I use sometimes, but it's not as effective as the MACD to me. The other thing that I use with the RSI is we talk about, what's it called? Divergences, where you see, like for instance, when you have a peak here and then another peak here, but this peak is lower than that peak, and the price action is actually higher. So it's like going the other direction. So when you see the price action going up, but it losing strength on the RSI, that's usually kind of a red flag that, yeah, it's going up, but it's probably not sustainable. It's probably going to have a drop at some point. And that is especially important to note on the longer term charts. Because as you can see in this particular case, it continued to go up a little ways. So we didn't really see it, bearing out right here. And then this one here, this peak and this peak actually are exactly where the candles are. We can see that this peak over here is higher than that peak, and this peak is higher than that peak. So they actually match. So that isn't really that helpful. It's just kind of reacting to what we are actually seeing on the candles. So that's not like a super helpful piece of information. But on the longer term charts, you'll often see a divergence. Let's look at the 15-minute chart because that's like one of the most effective ones. See if we can find one out here. Okay, well, here's one. It isn't super apparent because the price action is higher, but not like super duper higher than this one. So this is a peak that's almost equivalent to this peak here, maybe just slightly higher. But the RSI is quite a bit lower on this one than it is on that one. And then it was immediately after that we saw the big drop. So here's where a divergence would be very helpful in determining if this is going to continue to drop. Because when you saw that peak form and it kind of get to this point right here, which is really before the big drop, I think I would have gotten a little bit worried. So now we can see that at this point, it's changing a little bit on this day right here because the RSI is gaining momentum. Now the price action here didn't go up a great deal. Let me stretch this out a little bit here. It didn't go up a great deal, but it did go up, and that matters. When you see that the trough here is lower than the trough here, that means that the price action is starting to change direction, and you can definitely see that on the RSI. That is verifying what we're seeing in that point right there. It's gaining momentum, and sure enough, overnight it started to go up, and then it dropped back down again. So you always want to be careful and watch it, because you can see at this point the RSI got to the overbought place right here, and that was actually in the pre-hours before the opening bell. And when that happened, you can see the MACD as well had a death cross, and like we talked about before, we started to see the candles get smaller and turn dark green. And so at that point, you'd probably want to get out of a long position and not ride that down. So I hope that helped. These are the indicators and time frames that I just have played around with and found to be the most helpful. I tend to use 4 larger time frames on the left side here: 5 minutes, 15 minutes, 30 minutes. Sometimes I switch that to the 1 hour if I need some more information, and then the 4 hour. But on the main screen, what I actually trade on is the 1,000 tick. And once in a while, especially in the summertime, in May or afterwards, I'll switch that to 1,500 ticks or even 2,000 ticks, depending on how fast it's moving, so that I have the correct information there. That helps me to make good trades. And if I find that on a day where it's just not accurate, like I'm really struggling to predict what's happening. If I find that my predictions are just not panning out, I will often switch to a longer tick time frame, because that tells me that it's false information. It's giving me false readings. And so anyway, that's usually how I decide when to switch that. But for right now, it's moving fast enough that 1,000 ticks is just about right. Not too fast and not too slow. It's just the Goldilocks number. So thanks for joining me. Hope this helped.